there actually has been a study done as well, is that people who hire a financial advisor actually do better even after fees versus the average person going it alone. So while the world isn't perfect, there's nothing perfect in the world, having a percentage under assets under management is kind of the best imperfect solution for the current environment.
You don't want them to necessarily, the advisor, to essentially make no money. I don't know, there probably isn't exactly a right answer, but I think the better point here is that people should be. Hi everyone, I'm Jason Balara, and this is the Know Your Why podcast. Today I'm here with Earl Yaokasin. He's the founder of WealthArch Investment Services in Pasadena, California, where he helps high net worth individuals and couples build wealth through value investing and personalized financial planning. Earl, as I mentioned, I'll stop there because I'm going to hear your story through your words. But first, I want to say thank you for coming on the show. Thanks for taking the time out to chat with me today. I'm really looking forward to the conversation.
Well, first, thank you, Jason, for having me on the show. And I appreciate you inviting me over. So my story is really divided into two main parts. And one is the early journey, and the second is when I actually came to the United States. So hopefully from these two parts, your audience will take away what it is like to follow your dreams and to work hard and to establish my credibility as well in terms of how I got to becoming where I am right now in terms of being a great investment manager. So
great.
That's the goal, at least. I was born and raised in the Philippines. Ever since I was in first grade, I would go around the school and look for recycling bottles to turn in for the recycling credit. So I was very entrepreneurial, trying to make more money any way I can. And if I could get several bottles, I could get myself a yummy Filipino barbecue skewer. And have you ever had one, Jason?
I have not, but it sounds delicious.
Okay. We should have lunch one of these days near you. And there's some good Filipino restaurants for sure.
Okay.
Then in second grade, I would sell like these snappable bracelets with all different colors and designs, things like that. And as I grew older, I would sell things like CDs, concert tickets, cell phones, even go door to door to sell fireworks. But then when I was in sophomore in college, I turned on the TV and happened to see the CNBC channel. And I saw these things moving up and down. And then I told myself, hey, I think I can do this. I think I can make money off this, because I was always good at games. I was always good at math. I won a national competition for math in seventh grade, silver medal in the Philippines. And so I thought I could figure it out. And that started my lifelong journey into trying different methods, different strategies, and reading up books as much as I can. And when I was in my junior year, a year later, I interned for the Philippine Stock Exchange. So I was on the Philippine Stock Exchange floor where, people are shouting, things like that. Yeah. So it was quite exciting. And I did realize eventually that in the Philippines, it's more about who you know rather than what you know that will make you money. And that is not my strong suit. My strong suit is using my brains to make decisions. So I decided to go to the U.S. I came to the U.S. in 2001. I lived in Rancho Cucamonga at first. And because in the U.S., whenever you come from a foreign country, they don't recognize your credentials or your school, even if it's the best school in the Philippines, even if you graduated with honors like I did. And I had the toughest course as well in my school. They don't recognize all of that. So I have to start from the very bottom. So my first job was actually working as a data entry person at a Nordstrom warehouse in Ontario. And you could imagine that is as boring as hell. But I made it like a game. So I love games. So I tried to make it at a game. So every day I would come in and I would try to beat my previous record of whatever I entered previously. And everyone there was like so surprised. How come this new guy who just came in is beating people who've been doing this for 10 years? And I did well, but I wasn't satisfied because to make ends meet, working minimum wage, as you know, is not enough. So I had to move on to finding a new job. I worked at a real estate appraisal firm in Pomona. But even with that, even though it was paying me a higher wage, it wasn't enough. So I had to take a second job as a collector at Bank of America in Pasadena. So I lived in Rancho Cucamonga, then I traveled to Pomona, and then I traveled to Pasadena, pretty much every day for at least a year. And when eventually I was fortunate enough to be able to get a job as a financial advisor with American Express Financial Advisor. But to my surprise, financial advisors in the US, generally speaking, not all of them, of course, they're more like salespeople, and they really don't get enough training. They don't love investing. They don't have a passion for it. They don't study on it on their own free time. They just need to sell to make money. And that was quite a surprise for me. And it kind of disillusioned me. And sales really isn't my strong suit, even though I did sell a lot when I was younger. My trick was, for the most part, was to get some people under me and have those people sell more than I did. So that was kind of my trick. And so when I realized that, I decided to step away from the sales job and work for Bank of America Investments as a registered sales assistant in the Inland Empire. And I was fortunate enough to work with the top 2 investment advisors in the region. After working with them for some time, they entrusted me with making the decisions for their clients on the stock portion of their allocations, because they saw some talent there, and I did better for our clients compared to the in-house department that does it specifically, for the whole company. And so that was a good feeling. And after that, I started studying for the CFA level 1. That stands for the Chartered Financial Analyst designation. Have you heard of that, Jason?
Yes. Yep.
Yeah. So for your audience who, just in case, hasn't heard about it, it's the most prestigious designation in the industry. One of my former colleagues has mentioned this as it's 4 times harder to get than the CPA designation and 10 times harder to get than the CFP designation, which stands for Certified Financial Planner. So anyway, going back to my story, is that I eventually was able to work for the Capital Group here in Los Angeles, and they own the American funds. Have you heard of the Capital Group? Or
No.
American funds?
Nope.
So, okay. So when I joined them in 2007, they were approximately maybe the third or fourth largest global investment firm in the world, just behind Vanguard and Fidelity, something like that, and BlackRock maybe. And over there, while I was there, I was in a fortunate position where I created my own path, where I was kind of like the liaison between the investment group and the administration group and the compliance group, where if there was a large contribution like $1 billion or a withdrawal for $1 billion or any amount for that matter, the work that I did would help the administration team figure out which stocks to buy and sell more of in the portfolio. And in order to do that, I had to be on every single conference call that the managers have. I would have communication with them. I would read all their research reports. So as you can tell, there was a lot of learning, aside from continuing to learn from the CFA program, which was a grueling 3 years. While I was there, I created my own model portfolio, and I have my personal portfolio as well. And during the 7.5 years that I was there, my portfolio did better. My personal and my model portfolio did better than any of the analysts and the managers that I worked with. So I decided to set up my own shop in 2014. And now here I am 10 years later and helping clients earn more money from their investments.
Are you planning a remodel or construction project? Overwhelmed by the process? Over budget? Extended timelines? Strained relationships? We are all too familiar. At Lark Construction Services, we help homeowners and business owners take control of their construction journey, from reviewing bids and contracts to catching red flags before they become costly mistakes. Our Clarity Audit is a one-on-one expert review of your plans, estimates, or current progress, giving you the peace of mind and a defined action plan to move forward with confidence. Don't let confusion lead to costly errors. Visit larkconstruction.com and schedule your free call today. Lark Construction Services, saving you time, money, and stress.
Fantastic. A lot to talk about there, because I mean, this goes back to you. You were a businessman in first grade, selling barbecue skewers and slap bracelets and things like that. I mean, was there anything that inspired that? Did you have anyone as an example or suggest, or you just sort of naturally took to that kind of space, I guess?
Yeah, it was more natural. It was just inborn, where I just wanted to make more money. And I was extremely frugal. I do think that my parents were frugal, but I do think that I was just really inborn with it. And even as I grew older, compared to other people that I'm surrounded with. So for example, when I was doing the long commute, and by the way, I was commuting for not only during when I had two jobs, but also when I was with the Capital Group, I was commuting from West Covina to West LA. And as you can imagine, with the traffic, that's pretty crazy.
Yeah.
And even back then, I would try to just buy a foot-long sandwich, eat one half for lunch, and eat another half for dinner, just to try to save, keep saving. Yeah, I can't explain it to you. I think I was just born with it.
Just a natural affinity for financial acumen. But you said something about the sales side of things, that you said, oh, I wasn't a good salesman, but I just had people under me. I mean, that's like business owner 101, right? That you don't have to be the best at everything, right? You find people that are good at it so, I mean, I'm just fascinated that it's almost as if some of these things, these things came naturally to you. You did them maybe kind of without having someone, I don't know, put that in front of you, give you any demonstration, but you really took to business and the financial markets, even at that small scale as a child, quite naturally. So I think that's pretty amazing. And then your journey, through the levels up to owning your own firm, I think is just a fascinating picture of, determination and hard work and just the combination of putting your skills where they were best used. You did mention, and I don't know, certainly don't know anything about the Philippine financial advisory and things like that, but I do know you mentioned that it was more about who you know than what you know. I also have, certainly you're not the first person who I've heard say that in the US that oftentimes financial planners, financial advisors are basically salespeople. And I have felt that myself, and I have had people on the podcast who have experienced it and maybe, had a similar pivot to yourself. I wondered if you would talk a little bit more about, kind of some of those things that you found that you were in opposition that kind of forced you in a different direction as you sort of moved through the ranks, if you will.
Yeah, absolutely. So when I was at American Express, we had quotas to fill, and you need to have a certain quota. And if you're not, you're fired. And given that I was new to the country, I didn't know many people, that was just a hard hill to climb. So what I actually did was I partnered with two other people who our agreement was, okay, you guys do the selling, I will do the investing, because they had no idea to invest. Again, there's no real training or anything. So that was the agreement. But what happened was, because they really didn't understand investments, I would also have to do the selling myself. So pretty much they were able to set up the appointments, but I have to go to appointments and be the one speaking anyway. So that was actually what happened. And later on, it just felt kind of unfair that I would pretty much, they would set up the appointment, but I would do most of the work to get the client signed up and to invest. And we would split our revenues three ways. So that didn't work out. So a key lesson for me there was that I didn't, having partners and choosing partners is very difficult. And you want to be careful who you partner with, if anyone at all. And sometimes many businesses are actually better off not partnering off with anyone. The other thing that I learned from my American Express stint was that if you are pressured to sell, you are incentivized to not tell the truth. I never did that, but I can see other people who've done that. You are incentivized to sell high commission products just to make ends meet, because that's how you earn your living. You are incentivized to basically structure your day to be trying to get leads, trying to contact those leads, following up on the previous leads. In other words, kind of like a sales funnel. And that's pretty much what I learned. And I said, again, that not being my strong suit and being new to the country, that's not what I want to do. And so that's why I decided to shift to Bank of America Investment, which is now Merrill Lynch, in a non-sales capacity.
Yeah, it makes a lot of sense. And the main reason I wanted you to kind of explain that is because obviously someone as an insider, you understand where the incentives are. You understand kind of, what the client, or, what the service provider is looking at for the client and why they're looking at that. I would love to hear your take on what should someone who is they're in the market for a financial advisor, what should they be looking for? What questions should they ask? I think I've just, like I said, heard a lot of people, myself included, have gotten into a situation where they're like, I find out later that really wasn't the best advice for me. But then looking back, it's like, those are the only products that person had to sell, or whatever the case may be. And as you just mentioned, apparently there's quite a bit of pressure to get that done. So what should people be looking for? What questions should they ask? Like, how can someone get in good alignment with their financial advisor?
Yes. So the most frequent question that I get from prospective clients is, are you a fiduciary? And I actually think that's not a good question. In the beginning, I actually told them, you know what, that's not a good question. But if you're trying to sell, that's not what you want to say. Right. But so now I just think of it when people ask me that question. Yeah. But it's really not a good question. And the reason is they could just say yes. And how are you going to check? And for those who don't know, a fiduciary is someone who would put their client's interests ahead of themselves. But if they say yes, how are you going to check? There's no way you can check that. And so I would prefer to ask different questions in order to figure out if there is alignment with the advisor and the client. So the first thing I would recommend people asking is, how much of your money is invested the same way as your clients? And you will be surprised that Morningstar, it's a pretty popular investment website. They did a survey out of 10,300 mutual funds and ETFs in the U.S. Only about 5,900 actually owned no shares in their own fund. These are investment and portfolio managers. So if more than half of portfolio managers don't even own a single share of their own fund, and this is just a guess, I'm pretty sure that even a greater percentage of financial advisors also are not heavily invested in the same way their clients are. Because if they are, and there's a good number of financial advisors who just peddle life insurance products that give them 7% commission on whatever amount that their customers give, they're not going to do that to themselves knowingly, because they know who's making the money, and who's making the money is really the life insurance company and whoever gets the commission. So that's question number one. How are you? How much money do you have invested the same way as your clients? And by the way, for my firm and for myself, I have 100% of my net worth invested the same way as my clients are. This is excluding my emergency and opportunity fund. The second question I would ask is how are you incentivized? And if they say I get a commission out of a specific product, I get 5% if you buy this life insurance product, something like that, then you could warning bells should be you should be hearing warning bells, because what that means is that after the product is sold, it doesn't matter how the investment performance does, because they already got paid.
Right.
So you want to make sure that their compensation is structured in such a way where they would still care about how your portfolio does over time. So that's the other thing. And then the third thing I would ask as well is more about how do they invest? What is their strategy? Who does the research? How have they done when the market is going down? So these are questions that are extremely important, where you're asking about what they do, and their strategy will dictate as to how your returns going forward will likely be. So as an example, if someone says, I invest in the hottest areas of the market, AI, etc., things like that, whatever's going up, whatever's the flavor of the day, then you can figure out that this financial advisor is pretty aggressive. So that means that if the market is doing well, then you will make a lot of money. But also on the flip side, if the market's not doing well, then you could lose a lot of money. Mm-hmm. On the other hand, if the advisor says that, oh, I am a value investor, just like myself, I am a value investor. I subscribe to Warren Buffett's teaching of buy low, sell high, and only buying stuff when it's undervalued. So for people like myself, we kind of do the opposite of what everybody does. So what that means is that if the market's going up, up, and up, then we are most likely to be defensive. But when the market's going down, that's when we're aggressive. So what does that mean for people asking this question? Then you would understand that if the market's enthusiastic, then you're not going to make as much as everybody else. But when the market goes down and you're buying things aggressively, once the rebound happens, then on the way down, you're probably not going to lose as much as everybody else, and you're going to make more money than everybody else once the rebound happens, because the big money is made not when the market is going up. The big money is made is actually when you're buying stocks when everyone's panicking.
Right. Yeah. You mentioned the alignment of compensation structure. So, I mean, and I'd love to hear how you suggest that should be done, because I feel what I've seen is most of the time you have, some fee based on assets under management, right? So it's like,
yeah,
the advisor gets, X% based on assets under management, which goes up and down based on how much they have under management, but has nothing to do with performance. Like there's no, and then the other thing is, you said, commission on products sold. So, I mean, none of that has anything to do with performance of the investments. Is there some way that you tie it into performance? I mean, what do you suggest as a compensation structure?
Yeah, so it depends on the advisor situation, right? So I would say if the advisor is relatively well off, like, for example, they don't need any more money for the rest of their life, I think the ideal compensation structure is a percentage of profits, but that does lead to some problems in itself. So, for example, when Warren Buffett had his partnership in the early days, he structured his partnership where he would get 25% of the profits above 6%. So you can tell that the market over the longest period of time earns about 10%. Mm-hmm. And so on average, then you could imagine that Warren Buffett would, not Warren specifically, but the average investment manager could get 1% in fees, which is almost really just like the same as if it were a 1%, fee under management. The problem is that if you're a great investor like Warren is, and if you make 20%, then what that, or 20, I'm going to make the math easier. Like just, okay, so let's say it's 18%. And if he gets 25% above 6%, that's a 3% fee under management. So if you're a great investor, having that compensation structure actually hurts your clients even more than a 1% fee under management. But again, that if right, and not everyone is a great investor like Warren Buffett. He's obviously a very rare breed. But if you're not a good investor, what that structure does is that, hey, the advisor could not get paid, because if they don't make 6% or more, they get zero. So that's actually one of the best compensation structures that one can implement. But just realistically, because very few people who are well off want to become like an investment manager. It's just very few. And for the average financial advisor, they need some money to live off of. So unfortunately, I do think that the next best thing would be the fee under management. Like you said, even when the portfolio goes down, they get paid, which is a shame, right? Which is a shame. But what if the industry were to adopt this nationwide, where they would just get a percentage above 6%, there'd be pretty much no advisors. And so that's kind of the problem. And despite all that thinking that, okay, maybe the fee under management is not the fairest way, there actually has been a study done as well, is that compared to people who do investments by themselves versus having a financial advisor, even though the compensation isn't perfect, people who hire a financial advisor actually do better even after fees versus the average person going it alone. So while the world isn't perfect, there's nothing perfect in the world, having a percentage under assets under management is kind of the best imperfect solution for the current environment, at least as of now.
Sure. I appreciate that explanation. I think, all of those points make sense. It's a hard thing to identify, sort of the exact perfect compensation structure, because there are going to be, there's going to be times when we go through a recession, the market goes down, like where it's almost impossible to have, a positive performance. And so, you don't want them to necessarily, the advisor to essentially make no money. I don't know if there probably isn't exactly a right answer, but I think maybe the better point here is that people should be asking those questions. They should be asking what the compensation is. They should be asking realistically, probably track record, right? So if you're going to say, okay, well, most of those, advisors perform better than someone could do on their own, I would like to know that that's true. Like if I'm going to you as an advisor and say, okay, well, what have you, done for returns over the last X number of years? And so I think all of that just points to the questions that should be asked when you're trying to find that advisor to work with. Is there anything else you would add to that? Just any other points as far as what people should be on the lookout for?
Yes. So I actually was just going to interrupt you because I have one more thing I really wanted to add, which is people should ask not only about the performance for X number of years. What you want to ask for performance for during the down years, from 2007, 2009, what happened? Because really, if you think about it, from 2009 going forward, the market has pretty much had a smooth ride. COVID was one exception, but that was an external event. 2022 was another time the market was only down. When I say the market, the S&P 500, the largest 500 stocks, were down 20% that year. So you want to look for how the managers did on the bad times, not only on the good times. And the danger sometimes when people show, oh, this is my 10-year track record, but the last 10 years have been a bull market. So if you were aggressive, crazy, then you would show good numbers. But then the problem is that the market is not going to be great forever. Actually, large market corrections are fairly normal. So historically speaking, from 2008 and before that, for the last 100 years, Every year and a half, the stock market drops about 10%. Every 3 to 5 years, it drops 20%. And then every 7 to 10 years, there's a 30, 40, 50, 60% drop, historically speaking, on average. And from 2009 going forward, it's actually been a much smoother ride where, and this is just an estimate, not super exact, but maybe we've had 4 10% drops, maybe 3 or 4. We've had 2 20% drops, fourth quarter of 2018 and 2022, and then 1 30% drop during COVID. But we should have had double those numbers. And the reason why everything's smoother is because of the amount of money supply that's been printed by the Fed. So in other words, we've been printing money. The second reason is the amount of spending that the government has done, which is just stimulus checks, just various supports, various programs, especially during COVID, and the amount of spending that they made. In fact, last year, the government spent about 6.5% more than what they made as a percentage of GDP, which is extremely large. This year is actually projected to be even higher than that. So we've been spending as if we've been in a recession. And the last thing was just low interest rates from 2009 to 2021.
Great points. I think that is, historically things have not been what you would think they would be over these last decade plus. So who knows? Maybe we have a new historical norm. I don't know that anybody knows, but we'll see what happens over time. One other thing that you mentioned in kind of relaying your story to us, Earl, was that initial job of data entry, and you said you turned it into a game. I love that kind of mindset. And I think it's important to point that out for people that, like, you're going to have, if you're trying to get somewhere in life, there's going to be hard parts. You're going to have the job that isn't good. You're going to have, things come up. But if you can take that approach to it and take that mindset of creating a game, and I think ultimately that game is just doing the best at whatever you're doing, right? Like trying to be the best at whatever you're doing and kind of working towards that. So I think that is was worth pointing out, and I really like that part of the story. And even though that probably wasn't your favorite job ever or anything like that, favorite spot, but still, you did the right thing with it to then be able to move up from there. So important for people to hear that type of I guess enthusiasm's not the right word, but just that type of ability to even push through the hard part. So I like that.
Yeah, I think a lot of life is difficult, right? There's many parts that are boring. There's many parts where we experience pain and suffering, and sometimes tragedies happen in many people's lives. But everything is all about being able to see things in a different way and change your perspective. So if you can view a not so fortunate situation in a different light, that's going to be extremely helpful for people. And there is this famous Chinese parable, and hopefully I don't butcher it, but I'm just going to try to paraphrase. There's this farmer, there's this Chinese, old man who's a farmer. His horse ran away. And then the neighbor said, that's too bad. How are you going to farm now? And then he just said, let's just see what happens. And a few days later, the horse came back bringing 2 other horses. And then the farmer said, wow, that's amazing. You have such good luck. And then he just said, let's just see what happens. And later on, his son was riding the horse. The son fell down. His son got hurt, injured his leg. And then his neighbor said, oh, that's unfortunate. You lost the worker. How are you, that's quite bad luck. And he said, we'll see what happens. And then later on, the army started drafting people, into their recruits. And because his son was injured, guess what? He was spared from going to war. And then his neighbor said, wow, you're so lucky. And then he said, like, maybe not. And so it's just kind of like trying to just keep a calm perspective, whether it's turning something into a game like myself, to inspire you to work through the different stuff. So for example, another thing I did to get through the difficult parts of my life was when I was driving, sometimes 2 hours one way per day, one thing I would do is I would just sing like crazy, and that was fun. Just trying to turn your commute into something less boring. I was listening to CDs to help me study for the CFA, so trying to make sure that not to waste the time that I was spending commuting. So that's another way to think about it. And just like this Chinese parable is, if something bad happens to you, try to look for the silver lining. And I know it's easy to say, hard to do, but there are ways to manage. And do you play poker? Or
I mean, I have. I wouldn't say I'm good at it.
Okay, so
I don't think I'm. I don't think I could make any claims to having any talent there.
Okay, so that means we should play.
Yeah, you're right. Yes, if you're looking to beat someone
to make some money,
I could probably.
Yeah.
Yeah.
That's the other thing I did when I was younger too. I'm not like super proud of it, but I played cards for money, and I would win, of course. But anyway, going back to so you're dealt a certain hand. The hand you have no control over, but how you play that hand, you have complete control. And so by just realizing that you are not a victim, that you have control over certain things, not everything, but there are certain things that you have control over. And the biggest thing that you have control over is what's between this point and this point, between your brains, for those who are not watching the video. So that's the only thing you have control over. And if you have that proper mindset, you can turn any difficulty or any hardship and turn it into your favor eventually over the long run.
Yeah, I love it. I love that perspective. Also, it's a perfect transition to ask you the question that I ask every guest, which is based on the name of the show being Know Your Why. So what is your why, Earl? You just talked about how you find ways to work through the hard things and kind of turn that mindset around. And I think that often takes it takes a strong person to do that on a consistent basis. So if you would share a little bit more about your why and your motivation behind your positive mindset.
Yes. So I'm going to answer this question in two different ways. One from a professional standpoint and one from a personal standpoint. Yeah. So from my professional standpoint, intrinsically, the stock market is a game. It's a poker game with high stakes, very high stakes. Whenever a trade is made, somebody wins, somebody loses. I am out here to win this game. I'm here to win this game for myself and for my client's sake. We're out here to make money, and more money is better over the long term. Mm-hmm. Extrinsically, I'm motivated by my clients. So my clients entrusted me for some of them, with their almost entire net worth, like I am investing like my own money. And so for them, I have to make sure that we finish the race, meaning 40 years from now when my clients retire, and some of them are already retired, but for those young ones who've entrusted me with all their money, my goal is to make sure that they're able to achieve all their financial goals without blowing up, without needing to work at Walmart. So the most important thing is to grow their money safely, but also at the same time at an appropriate rate so that they can achieve their goals. So that's what motivates me professionally. In terms of personally, my wife and kids are the most important people of my life. I wouldn't be here without the support of my wife, and I do everything for them. And the only thing I want when I die is that my wife and my kids would say that I was a great father and I was a great husband. That's all I want.
That's all that matters. Love it. I love it. I could not agree with you more on that one. That's a fabulous motivator for sure. Earl, this has been a fantastic conversation. I've really enjoyed what you shared. Thank you so much for coming on the show today. Thanks for imparting your wisdom on us. I really love the kind of mindset around making everything a game and to get you through those hard moments. So thank you for being here. Appreciate your time today.
Well, thank you, Jason. I appreciate it.
Folks listening, I forgot. How can people reach you if they want to reach out?
Yes. So we created a special link. People can go to this special web page that we created. It's mywealtharch.com/knowyourwhy. So let me spell that: mywealtharch.com/knowyourwhy. And when they visit this page, they can learn more about how we're different than other advisors. There's about 19 or so reasons how we're different. They can also subscribe to a free 30-day newsletter. And it's actually more than just a newsletter, because within the next 30 days, they get access to all my investment updates, which includes anything that I'm buying and selling over the next 30 days. So it's a significant value that even financial advisors pay me money for. So that's available. And finally, if they wanted to just schedule a conversation with me, they can do that through this webpage.
Fantastic. We'll get that in the show notes so they can connect with you. Again, thank you, Earl, for being on the show today and everything you shared. And folks listening, make sure you connect with Earl. We'll have that link in the show notes. Please like, rate, and review the show so we can continue to get great guests. And as always, thank you for listening.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?